Hi everyone, and welcome to our channel. Today, we're going to talk about inflation, its effects on the economy, fractional reserve banking, and the different types of banks globally. We will also take a look at how banks affect our money. So what is inflation? Inflation is a key economic concept that refers to the increase in prices for goods and services over time. This rise in prices is caused by the devaluation of currency and results in a decline in purchasing power. In simple terms, if the inflation rate is high, then the same amount of money can buy fewer goods and services compared to the past. The rate of inflation is often measured over a specific period of time and can be calculated using various metrics such as consumer price inflation, which measures the rate at which prices of goods and services bought by households rise or fall. In severe cases, where prices rise by at least 50% each month, inflation is defined as hyperinflation. Inflation can be classified into three types: demand pull inflation, cost push inflation, and built-in inflation. The general increase in prices is an indicator of an imbalance in the overall economy, which is a concern for policymakers. In conclusion, inflation refers to the rate of increase in prices for goods and services over time and results in a decline in the purchasing power of currency. It is a widely studied concept in economics and can be measured using various metrics such as consumer price inflation. The effects of inflation are far-reaching and can have a significant impact on both individuals and the overall economy. How does inflation affect the economy? Inflation affects the economy in various ways. For instance, it reduces the purchasing power of consumers, leading to lower demand for goods and services, which in turn affects business sales and profits. In addition, it affects the value of money, making it less valuable over time, which can result in people saving less and spending more. Meanwhile, the money you hold on to is worth less each year. Meaning leaving your money in banks is the fastest way to lose money over time. Money is created to never stop moving. The moment your money movement becomes dormant is the moment your wealth decreases. 10K in 2020 would have the same buying power as around 14K does today. What is fractional reserve banking? Fractional reserve banking refers to the practice of commercial banks holding only a fraction of their deposit liabilities as reserves. This allows banks to lend out the rest of their deposit liabilities, creating new money in the process. This system can increase the money supply and lead to inflation if not managed properly. This not only means the banks borrow money they don't actually own, but this means the taxpayer must cover all national debt. More money generated equals more debt, which equals higher taxes, and cost of living crisis seen in 2023, and ongoing to worsen. Fractional reserve banks allow the banks to create money out of thin air. A few clicks on the keyboards and the money is generated, alongside generating an asset in the bank's accounting sheet, which is the debt you owe them. Different types of banks in the UK and USA. In the UK, there are different types of banks including high street banks, building societies, and investment banks. High street banks offer services to retail and business customers, while building societies offer savings and mortgage services. Investment banks, on the other hand, specialize in investment banking services such as underwriting and trading. In the USA, there are different types of banks including commercial banks, savings and loans institutions, and credit unions. Commercial banks offer a range of services to retail and business customers, while savings and loans institutions focus on savings and mortgage services. Credit unions are non-profit financial cooperatives, offering savings and loan services to their members. How do banks affect our money? Banks play a crucial role in affecting the money supply and the economy as a whole. For example, They can influence the money supply by controlling the amount of money they lend, which can affect inflation and interest rates. Additionally, banks can affect our money through the services they offer, such as mortgages, loans, and savings accounts. They can also play a role in stabilizing the economy during a financial crisis by providing loans and other financial services. Be sure to check out future up and coming videos designed to teaching you how to make the most of the unfairly rigged system. And that's it for today's video. I hope you enjoyed the information on inflation, its effects on the economy, fractional reserve banking, the different types of banks in the UK and the USA, and how banks affect our money. Don't forget to like and subscribe for more informative videos. Be sure to comment on any questions and information you would like to learn in up and coming future videos. And as always guys, be lucky.